how's this week been?
How are you?
How are you? It looks like we saw the capitulation on Monday. Do you see a turning point from here?
It feels like it. I mean, it was definitely somewhat of a buyer's strike on Monday. A lot of concerns. But then when you look at just the economic side of China and the valuation argument, it's still very attractive, right, in terms of opportunities. I mean, the internet sector itself and some of those large internet names can be classified as value these days. And I think that dividend yield story is still very, very important. It goes unnoticed when it comes to what companies are doing in terms of the payouts and rewarding minority shareholders.
Well, is it time to buy? Is it safe to buy? Is the other question? Do you get that question?
Well, the risk premium is more than likely to continue to rise or has risen. But in terms of, again, if we look just at the economics of China, given the world we live in today and all the policy movements we're seeing elsewhere around the world, China really is at the other end of the spectrum. So they have the flexibility to ease and the tool set. And you're probably going to see some further fiscal supportive measures being announced in 2023 and more economic policy being announced in the working committee, the two-party meeting, and that's probably going to provide further clarity. But it's again, this sort of treading water, and we might have seen some part of the foreign investment community just saying, given everything that's happened and the uncertainty and opaqueness, we're just going to bow out for the time being.
How do you look at themes like common prosperity and dual circulation? Because I think the kind of narrative coming out of the party Congress is that those things are staying put. So is COVID-0. Can you still make logical sort of investment strategies around sort of these themes still?
You can, and the policies that aren't new. We've been talking about these policies or hearing about these policies for quite some time. The market somewhat ignored, though, some of the economic pro-growth policies that were announced. So this continuation of high-end manufacturing, really that push towards R&D in terms of the healthcare, providing better healthcare, which is also part of common prosperity. So it seemed that the market movements we did see on Monday were a little bit of panic selling, as I said, that buyer's strike, and a little bit overdone in terms of what we did see. Interestingly, though, the domestic flows were still okay.
Mm-hmm. How are you approaching just the fundamental story, since we're talking about valuations, right? So we're getting into the thick of earnings season in the U.S. We're getting some numbers coming through out of SK Hynix, for example, which is a chip story, obviously. Some numbers out of China. And most seem to be pointing to revisions, further revisions for it, because we are getting the slowdown showing up in earnings.
Yeah. And China, again, is probably one cycle ahead, even when we look at the earnings story, not just the monetary policy cycle. And so we've seen a number of deratings over the past 1 or 2 years when it comes to earnings. Now, I'm not saying all earnings are really rosy in China, but again, there are so many pockets of opportunity. And I think, again, one side of the China story has sort of taken precedence over the other in terms of the ignoring of fundamentals and the valuation story.
Do you think this is just indiscriminate selling that we're seeing? You talk about, tech, property, certainly we're seeing most of the pressure, but banks actually did a little bit better. Yeah. Why is that?
Well, again, if you were really concerned about what's going on in China, you would have seen the banks really sell off. So it was those well-loved names. And on Monday, 80% of the flows we did see, or outflows, were foreign investors. So those names that were held, so the big proxies of China, were the ones that sold off. And, again, when you look at some of those names, like some of the internet names, but from an EV basis, they look cheaper than some of the big energy-related names. So, again, it's about whether you can see that earnings visibility, whether you can see that market share of the various companies continue to grow or remain relatively robust. And those recovery plays, I mean, we could see, again, tweaks to the COVID policy. It's not going to be a 180-degree turn. Already yesterday there was commentary about, business travel into China. So probably tweaks around the margin. And then again, these recovery names could actually, seem profitable or reward shareholders going into 2023.
So still defensive, still income-based strategies make the most sense, is what I'm getting from what you're saying?
Yeah, and also that domestic investor base. We talk about the Chinese consumer and the rise of the consumer, and household assets, by the way, attractive. The savings rate's over 30%. So it's not that Chinese households don't have the money to spend. They're just probably, cautious given sentiment. But that domestic investor story, that's really, really key, because the development of capital markets, especially with the property situation, is going to be key for growth going forward. Important for foreign investors, but also very important for the domestic investors.